I am a huge proponent of dividend growth investing, and my primary investing focus is top quality dividend growth companies. Dividend growth investing provides a growing stream of cash flow that I will be able to use to fund my living expenses later in life without having to sell my shares. By introducing covered calls to my investment plan, I am able to double my dividend or more. In this video, I will provide an introduction overview of what covered calls are, the possible outcomes of writing covered calls, how to structure your covered calls conservatively with dividends in mind, and two methods I use to gain additional cash flow on my portfolio. For those who may not be familiar, a covered call is a type of options contract in which you, as the holder of 100 shares of a company, can sell a contract to an unknown person to sell your shares at a price that you determine and a timeline that you determine. As the seller, you are in control of the contract details. You set the price, you set the contract length, and you get to agree to the amount of income you are willing to accept for writing this contract. The buyer of your covered call contract will pay you cash up front for the right, but not the obligation to buy your shares from you during the contract period at the price agreed on. This cash can be used to buy more dividend stocks or anything else you want to use it for. There are three basic outcomes from doing a covered call option contract. Number one, the stock price increases, but never gets to the contract price within the set time frame. You get to keep the premium, and you get to keep your shares, and you're able to write another contract the next week. Number two, the stock price goes down, you keep your premium and your shares, and you can write another contract after this contract expires. The third one is the stock price goes over the contract price. The buyer of the contract can exercise their right and force you to sell your shares to them at the agreed upon price. You will get the contract cash value of the shares and can use that money to buy back the shares on the market or use the money to buy something else. In all three scenarios, you keep the premium. And if you set it up correctly, even if the stock price goes up and your shares get exercised, you still gain from the price appreciation up to the contract price. These premiums are cash in your pocket that you can use to buy more dividend stocks, thereby adding to your stockpile and getting even more dividends later. You can be as aggressive or as conservative as you feel comfortable. An important concept to understand when writing calls is called delta. Delta is one of the Greeks that are relevant to option trading. Delta is a theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security. In more practical terms, delta represents the approximate likelihood that an options contract expires in the money and the contract will be exercised. A delta of 0.30 means that there is an approximate 30% chance of the buyer profiting from this trade. As a seller, and as on the opposite side of the trade, means you have an approximate 70% chance of the contract not being exercised and you keep your shares. The higher the delta, the more risk there is of exercise. Since I am a dividend investor, I avoid writing a contract during ex-dividend dates so that I can get the dividend payment as well. I also do not sell calls during earnings since that is when the stock is most volatile, and I want this to be a conservative approach. These two scenarios above mean that I can sell calls on around 44 weeks out of the 52 weeks a year. So I'm going to avoid the 4 ex-dividend dates that most companies pay every year, and the 4 earnings report that each company reports. I use two different strategies for selling covered calls depending on my goal. The first method I use is called portfolio overwriting. This is for those holdings where you don't actually want to risk your shares, but you want to gain a little additional income on them. For these holdings, I strive for a 5 to 6% return from the options premium per year. This is a low-risk goal that will let you gain some additional income while greatly reducing your chances of having your option exercised. I use this method for my super stable dividend companies that I have a low cost basis on and don't want to have to sell and rebuy at the current higher prices. The strike price I pick for these would be a minimum of 10% higher than the current price for each month until expiration of the call contract. If it is a weekly call, I would not go any less than 2.5% over the current price. This allows the value of the shares to increase without getting too close to the strike price. You will not be getting a lot of money each time on these contracts, but consistent small wins will add up over time. For instance, Starbucks ticker SBUX, is currently trading for $98.89. With this, I would look for a strike price around $103. This would give a 4.15% upside room, and it would pay around $13 for the trade for the next 10 days, which is a 0.13% return. If you did this just 25 times a year, that is an extra $325 on top of the $212 you would get in dividends from them. This would turn your normal cash flow from 2.16% with the current dividend to 5.43%, including the options premium, while being very conservative with a delta under 0.10. The second method I use is traditional covered call writing. In this scenario, I am okay with my shares being exercised since my main goal is to get the highest premium. This would be for holdings that have not appreciated much yet and your cost basis is close to the current price. It can also be used if you're buying a new stock and you want to buy 100 shares of it and immediately sell the call to make the most premium. This method is just about focusing on the immediate premiums you received and also a little principal increase, as well as collecting the dividend. Using the same example of Starbucks, if it's currently selling at $98.89, I would look to sell the 101 strike price for a week to 10 days out. This will get you a high premium, but leaves you little capital appreciation. In most market scenarios, your shares will likely be exercised and you will sell your holding at the end of the term. You're limiting your upside, but since you already locked in your income from selling the call, you're okay with that risk. This particular trade has a delta of 0.2524, so there's about a 25% chance of your shares being taken away. You can increase your delta to obtain more premium, but you take on more risk and less upside on the share price itself. For these covered call trades, I look for a premium from writing the call between 1 and 2% a month. For this example above, you can likely receive around $40 in premium for a 10-day contract, or an initial premium return of 0.40%. Plus you have the chance of a little bit of capital appreciation. This equates to 1.21% monthly return on the premium. If you do this 25 times a year, that would be an extra $1,000 in addition to the dividend of $212 for the year, resulting in an annual return from the dividends and covered call contract of 12.25%, plus you have the potential of some capital appreciation. If you note, I didn't write this contract every single week of the year because you want to have the chance of collecting the dividend as well as avoiding the earnings calls. If the option is exercised, then you can choose to rebuy the shares and do it again, or pick a different company to buy and sell calls on. If the option is not exercised, you keep the shares and you can write another call. Either way, you've already received the premium income. So you're thinking, this sounds great, and I'm on board. So now what? The first step is to apply at your broker to be allowed to trade options. For covered calls, you need to be approved for level 1 options. Once that is set, you'll need to locate a company that you have 100 shares of or are willing to buy 100 shares of that company. Each broker has a slightly different user interface, but you will need to locate the options chain from your broker. Once on the options chain, you can find the expiration date and the strike price that you're wanting to use, and at the delta that you're comfortable with, and check out the bid-ask pricing for the premium offered. Once you find the right one for your trade, click on that line and your broker will open up the trade window. Complete the details of the trade, including sell to open, which tells your broker that you want to open a call option to sell your shares. The quantity, remember, one contract equals 100 shares. Make sure to use a limit price and enter the amount you're willing to accept. Click on the complete the order, and if there is a buyer, you will receive the stated amount into the cash balance of your investment account. If a buyer isn't available at that price, you can go back in and adjust the limit price and try again. This overview is meant to be an introduction to selling covered calls on your dividend stocks. Please do further research and more learning before making any trade to ensure that you fully understand the process and risk of selling covered calls. Selling covered calls has been a game changer for my cash flow and has allowed me to add even more money to my dividend stockpile. Please remember, this is not financial advice. This video is for entertainment and information only. Investing involves risk, and please do your own due diligence and research before completing any investment decision. Thanks for watching. See you soon.